Okay, let's dive in. We're tackling the 2024 10K filing for Micron Technology Inc. today. You send it over, and our mission is basically to cut through all that dense corporate speak.
Right. Hundreds of pages. We want to pull out the really important stuff for you.
Exactly. What actually matters about their business, their financials for the year ending late August 2024, the risks they see, and, where they're heading.
Think of it like getting Micron's own official summary. It's what they tell the SEC, what they tell investors. It's all in there, but yeah, it can be a lot.
Totally. These 10Ks are treasure troves, but definitely not light reading. So we're here to sort of navigate it for you.
That's the plan. Break it down, look at the key parts, and give you the picture straight from the source.
Perfect. So let's start right at the top. Who exactly is Micron Technology, according to this filing? Just the basics.
Okay, so the filing says they're incorporated in Delaware. Headquarters are in Boise, Idaho.
Right.
And their stock ticker, which you probably know is MU on the NASDAQ.
Got it. And how do they describe what they actually do, their core identity?
They call themselves an industry leader in innovative memory and storage solutions. Pretty standard description.
Right.
Their bigger goal is kind of ambitious, transforming how the world uses information to enrich life for all.
Okay. Big picture.
Yeah.
But in terms of actual products, what does that boil down to?
It boils down to the nuts and bolts of computing, really. High-performance DRAM, NAND, and NOR memory, plus storage solutions built on that.
The memory chips and drives we see everywhere.
Exactly. And you might know their consumer brand, Crucial. That's them, alongside the main Micron brand.
Right. Crucial SSDs and RAM. Okay, so where do these products end up? Who are they selling to?
It's pretty broad. They talk about fueling the data economy, think AI, cloud computing, big data centers, but also all the way out to what they call the intelligent edge. So that's cars, industrial machines, smart home devices, consumer electronics, and of course mobile phones.
So everything from the biggest server farms down to the phone in your pocket. Makes sense. The filing also mentions they're a large accelerated filer. What does that mean for us?
It's mostly an SEC classification. It basically just signals they're a big established company. Means they have to file their reports like this 10K faster than smaller companies.
Yeah.
Within 60 days of year end.
Okay, just a marker of their size and status. And speaking of size, they put a number on their market value.
Yeah, they mentioned the aggregate market value of their common stock held by non-affiliates. Basically, the public float was about $83.6 billion back at the end of February 2024.
Definitely a major player.
No doubt.
Okay, that's a good snapshot. Let's get into the core products now. You mentioned DRAM, NAND, NOR. Let's unpack those a bit. This is where the tech gets interesting.
It really does. Okay, first up, DRAM. Dynamic Random Access Memory.
That's the main memory in computers, right? RAM.
Exactly. It's volatile, meaning it needs power to hold data, but it's super fast for retrieving data the system is actively using. So data centers, PCs, graphics cards, automotive, industrial, it's everywhere.
And what advancements did they highlight in the 10K for DRAM?
They talk a lot about their manufacturing nodes, basically, how advanced their production process is. In fiscal 24, most of their DRAM was made on what they call their 1 alpha and 1 beta nodes.
1 beta, that was a big step, wasn't it?
Yeah, the 1 node was an industry first when they rolled it out.
Yeah.
Better power efficiency, more memory bits packed in the same space. That was key.
And what's coming next? What are they looking towards?
The next big thing is their 1 gamma node. They expect volume shipments using that technology in 2025.
Okay.
And the really significant part there is that 1 gamma will use EUV lithography.
Extreme ultraviolet. That's the cutting edge stuff for making chips smaller and denser.
Precisely. It's a major complex manufacturing shift for DRAM. Big investment, big step forward if they execute well.
Okay, so a big tech transition happening in DRAM. What about NAND?
NAND flash, that's your storage memory.
Yeah.
Non-volatile, so it keeps data when the power's off.
Like in SSDs, USB drives, phone storage?
Exactly. They make different types, like TLC and QLC, which offer different balances of density, performance, and cost.
But what's the trend there? What progress did they report?
It's all about stacking layers vertically to get more storage capacity in the same footprint. They started volume production of 232-layer NAND, which they called G8, back in 2022.
Okay.
And in fiscal 2024, they started volume production of the next generation, G9 NAND. They also announced they shipped their densest QLC NAND using that G9 tech during the year.
So more layers, more gigabytes.
That's the basic idea, yeah. Keep packing it in.
Got it. And NOR, you mentioned that one too.
Right, NOR flash.
Yeah.
It's also non-volatile, but it's typically used differently. It's often faster for reading data, but less dense for bulk storage compared to NAND.
So where do you find NOR?
Think reliable code storage, like the boot up code for a system, or the operating system in some embedded devices. Automotive, industrial, consumer gadgets often use it where you need fast, reliable access to smaller amounts of critical code or data.
Okay, makes sense. They also mention multi-chip packages or MCPs. What are those?
Yeah. MCPs are basically about clever packaging. They integrate multiple types of memory chips, often LPDRAM, which is low-power DRAM, and maybe some NAND, into a single physical package.
Why do that?
It saves space and often power. Crucial for things like smartphones, wearables, embedded IoT devices, some automotive systems. Anywhere that physical board space is really tight or power consumption is critical.
Smart integration. Okay, now let's talk about the really high-performance stuff that's everywhere in AI discussions. High bandwidth memory, HBM. Specifically, they mention HBM3E.
Yes, HBM is absolutely vital for AI accelerators and high-performance computing. It stacks DRAM chips vertically, right on the package close to the processor, to get incredibly high data transfer speeds.
And what's their status with HBM3E?
In 2024, they hit volume production with their 8 high stack. That's 8 DRAM chips stacked up, delivering 24 gigabytes of HBM3E capacity, built using their 1 DRAM process. And the benefits. They highlight increased bandwidth compared to older HBM, naturally, but also better power efficiency and improved thermal performance, how well it handles heat, which is a huge issue in AI hardware.
And they're already looking beyond that.
They are. The filing says they've started shipping samples of a 12 high-stack HBM3E part. That's 36 gigabytes of capacity. These are production-capable samples going out to the AI ecosystem players for testing and qualification.
Wow, pushing the density even further. They also talk about DDR5 quite a bit. How does that fit in? Isn't that more standard memory?
It is the current standard for main memory in servers and newer PCs, DDR5. The filing points out it's important because as CPUs get more and more cores, the memory bandwidth per core can actually decrease. DDR5 helps address that by offering higher bandwidth than the previous generation, DDR4.
Okay.
And in 2024, they qualified and started shipping a pretty massive 128 gigabyte DDR5 server module.
128 gigs on one memory stick. That's huge.
Yeah, built using their advanced 32 gigabit NAND DRAM die on the one node. They position this high-capacity module as an alternative to some of the more complex, vertically integrated solutions like those using 3D TSVs, often seen with HBM for certain memory-hungry AI tasks running on more standard servers.
Interesting. So trying to bring some of that high-capacity benefit to the mainstream server market for AI.
Kinda, yeah.
Yeah.
And they're also looking at using LPDDR, the low-power DRAM usually found in phones for servers, specifically targeting power savings in the data center.
Okay.
And they also announced a 256 gigabyte MRDM module. That's another technology aimed at boosting performance and packing even more memory capacity into each server.
Always pushing the capacity boundaries. What about the mobile market specifically? Their MBU, our mobile business unit.
Right, MBU. That covers memory for smartphones and other mobile devices, discrete DRAM and NAND chips, managed NAND solutions, and those MCPs we talked about.
And the focus there.
A big focus is enabling AI directly on the phone, Edge AI. So in 2024, they rolled out their second-gen UFS 4.0 devices. UFS is the standard for fast storage in smartphones.
Right.
These new UFS 4.0 parts are designed to be really compact and power efficient, which is critical for sleek smartphone designs.
And on the mobile DRAM side.
They started sampling their next-gen low-power DRAM for smartphones, LPDDR5X, built on that one node. This is aimed at the high-end, flagship phones. It offers the high bandwidth and power efficiency needed to run complex AI models right there on your device.
Okay, great overview of the tech and products. It's clear they're pushing innovation across the board. Now let's connect this to the business side. How did all this translate into revenue, and how do they break down the business?
Right, the structure. They report sales across 4 main segments or business units. First is CNBU, compute and networking. That's data centers, client PCs, graphics cards. So HBM, DDR5, GDR6 DRAM, that kind of thing.
Okay.
Then NBU mobile business unit. Pretty straightforward. Smartphones, tablets. LPDDR, managed NAND. Third is EBU embedded business unit. This is that intelligent edge concept, automotive, industrial automation, consumer electronics. Uses a mix of DRAM, NAND, SSDs, and NOR.
Right.
And finally, SBU storage business unit. This focuses on SSDs and NAND components mainly for enterprise and cloud data centers, but also client PCs and the consumer market through their crucial brand, SSDs.
Okay, CNBU, MBU, EBU, SBU, covering all the major markets. So how did the revenue look across these over the last few years? You mentioned volatility earlier.
Yeah, the total revenue numbers really tell a story. Fiscal year 2022, they pulled in $30.76 billion. Pretty strong.
Okay.
Then, fiscal 2023, a massive drop, down to $15.54 billion.
Wow, nearly halved.
Exactly. And then for fiscal 2024, a partial recovery up to $25.11 billion.
That is a wild ride. Over $30 billion down to $15 billion, back towards $25 billion. What on earth caused that huge swing, especially the drop in 23?
The 10K is very clear on this.
Yeah.
The main culprit for the 2023 plunge was a steep decline in average selling prices, ASPs.
The price of the memory chips themselves just collapsed.
Collapsed is the right word. They say DRAM ASPs fell by like high 40% range, and NAND ASPs dropped even more in the low 50% range. Just brutal price drops.
So even if they sold a similar number of chips?
Well, they actually sold slightly more NAND bits, but the price decline was so severe it just overwhelmed everything. Revenue cratered. The recovery in 24 came partly because ASPs started moving up again, and they also worked on manufacturing cost reductions.
Okay, so the big takeaway is just how incredibly sensitive their business is to the market price swings for memory.
Absolutely critical. It's the inherent nature of this commodity-like semiconductor market. Boom and bust cycles are kind of baked in.
And that sensitivity must just hammer their profitability metrics. Let's look at the financial health side. How did gross margin hold up through that?
It shows the volatility, plain as day. Consolidated gross margin was a very healthy 45% back in fiscal 2022.
Wow, 45%.
Then in 2023, it plummeted, went negative 9%.
Ouch. Negative gross margin means they were selling chips for less than the direct cost to make them.
Essentially, yes, on average, across the board, factoring in some major charges. For 2024, it recovered significantly, back up to 22%, which is better, but still, roughly half of what it was in 2022.
What drove that negative 9%, besides the falling prices?
Well, the prices were the main driver, but 2023 also included huge one-off, or hopefully one-off, charges. They took $1.83 billion in inventory write-downs.
Billion, with a B.
Billion, yes. Basically acknowledging that the inventory they were holding was probably going to sell for less than it cost them to manufacture.
Okay.
Plus another $382 million in costs related to underutilizing their factories. Demand was so weak they couldn't run their fabs efficiently, and that has a cost.
Right.
The improvement in 2024 came from prices recovering somewhat, lower manufacturing costs, and, crucially, selling some of that inventory that had already been written down in 2023, which helps the margin calculation.
Okay, those inventory write-downs, that's based on estimating future selling prices right, if they guess wrong or the market moves against them.
Exactly. It's a critical accounting estimate called lower of cost or net realizable value. They have to project future ASPs. And the filing is a really stark illustration of this.
Oh, yeah.
They state that as of the end of fiscal 2024, just a 5% decrease in their estimate of future average selling prices could potentially reduce the carrying value of their inventory by around $700 million.
Wow. A 5% price assumption change hits inventory value by $700 million. That single detail really drives home the risk and the impact of that price volatility directly on their financial statements.
It's huge. It underscores the sensitivity.
Yeah.
You can see this flow right down to the bottom line, the net income or loss.
Let's see their numbers.
Okay, fiscal 2022, $8.69 billion net income. Fiscal 2023, a massive $5.83 billion net loss.
A $14.5 billion swing from profit to loss in 1 year.
Incredible volatility. Then fiscal 2024, they swung back to a profit, but much smaller, $778 million net income.
So $8.7 billion profit, $5.8 billion loss, $7.8 billion profit, just extreme swings. How did their cash flow look through all of this? Did they burn through cash in that loss year?
Interestingly, their cash flow from operations held up better than the net income suggests, especially in 2024. It was $7.69 billion in FY24.
That's pretty strong.
It was much lower in the tough year, 2023, at $1.19 billion. And back in 2022, it was $4.10 billion.
So even in the big loss year, they were still generating over $1 billion in operating cash. Why the difference between net loss and cash flow?
Non-cash charges are a big part of it. Things like depreciation, stock-based compensation. And importantly, in 2024, the benefit from selling that inventory previously written down boosts cash flow relative to income.
Okay, so operationally, they managed to keep generating cash. How much cash did they actually have on hand at the end of the last fiscal year?
End of August 2024, they reported $7.05 billion in cash, cash equivalents, and restricted cash. That was actually down a bit from $8.66 billion the year before.
And they carry a fair amount of debt too, right?
They do. Total debt carrying value was $13.4 billion as of the end of fiscal 24.
13 billion. Where does that come from?
Various sources. Term loans, senior notes they've issued, some green bonds tied to environmental projects, and finance leases for equipment.
And does the 10K talk about the impact of that debt?
Yes. It points out that servicing this debt requires a significant chunk of their cash flow, which, can limit their flexibility for other things, like investing in R&D or big capital projects. It could also impact their credit rating and ability to borrow more easily in the future. Debt always adds financial risk.
Makes sense. With those huge profit swings, how did they handle returning cash to shareholders, like stock buybacks and dividends?
They have a large share repurchase authorization up to $10 billion, with about $2.8 billion still available at the end of FY24. But you can see how they adjusted based on the market conditions.
How so?
In the strong year, 2022, they bought back $2.43 billion worth of stock. But in the tough year, 2023, they pulled way back, only $425 million. And in 2024, as things recovered, it was $300 million.
So if they throttled the buybacks significantly when times got tough, what about dividends?
They've been paying a quarterly dividend. It was 0.115 cents per share in each quarter of fiscal 2024. But they're careful to state in the filing that future dividends are discretionary, decided by the board each quarter. They're not locked in.
Okay, so clearly navigating a major downturn in 23, showing recovery signs in 24, backed by decent cash flow despite the income swings, managing significant debt, and being flexible with shareholder returns. This leads us nicely into their plans for the future, especially those huge investments in new manufacturing capacity.
Yeah, this is a really major theme in the 10K. They state clearly they see a need for significant new DRAM wafer capacity, specifically coming online in the second half of this decade.
And the big focus for building that new capacity is the United States.
Very much so, largely driven by the incentives offered by the U.S. CPS and Science Act. They have plans for 2 massive leading-edge memory fab projects in the U.S.
Okay, where are those?
The first is in their hometown, Boise, Idaho. They broke ground back in September 2022. And construction actually began in October 2023. They're projecting meaningful DRAM output from that site around 2027.
And the second location?
That's a really ambitious one. Clay, New York, near Syracuse. The plan there is potentially for up to 4 large fabs, built out over 20 years or more.
4 fabs. Wow.
Yeah, site preparation is expected to start in calendar year 2025, with the first production ramp happening in the latter part of the decade.
These sound like incredibly expensive projects, multi-billion dollars each, I imagine. The filing must talk about government support.
Absolutely critical. They detail the potential government incentives. For the U.S. CHIPS Act, they mention having non-binding preliminary terms agreed with the Department of Commerce for up to $6.1 billion in direct funding.
$6.1 billion in grants.
Potentially, yes, for the Boise project and the first 2 fabs planned for New York. They're also eligible for up to $7.5 billion in federal loans, if they choose to take them. And on top of that, they get a 25% investment tax credit on their qualified U.S. manufacturing investments starting back in 2023.
That is a massive amount of federal support. What about state-level help?
For the New York project, they have a non-binding agreement with the state for up to $5.5 billion in incentives over the 20-plus year life of the project, mostly through tax credits linked to job creation and investment.
So it seems fair to say these huge U.S. expansion plans are heavily reliant on actually getting that government money.
The filing makes it pretty clear that these incentives are a key enabler for the scale and timeline of these projects. But it's not just the U.S. where they're expanding and getting support.
Oh, where else?
In Japan, they're upgrading their existing fab in Hiroshima, specifically enabling cleanroom space to produce advanced DRAM using that EUV technology we talked about. The Japanese government has committed up to $1.3 billion to support that project.
Okay, Japan too. Any others?
India. They've started construction on a completely new facility in Gujarat. This one will focus on assembly and testing of memory chips, not wafer fabrication. It's aimed at meeting demand in the second half of the decade.
And government support there?
Significant support. The filing notes commitments totaling up to $1.8 billion, which they say covers 70% of the project cost. It's a mix of funding from India's central government and the state government of Gujarat.
Wow. And China? Any expansion there?
Yes, they mentioned they're expanding their existing assembly and test facility in Xi'an, China. The stated goal is specifically to better serve the demand from their customers within mainland China.
So it's a truly global manufacturing expansion strategy, often leaning heavily on government partnerships and incentives. But building all this new capacity must come with enormous risks, right?
Oh, absolutely. And the 10K dedicates a significant section, item 1A, just to laying out these risks is quite extensive.
What are some of the big ones related to these expansion projects?
Well, first, just being able to fund the massive capital expenditures required, especially if the market takes another downturn and their cash flow gets squeezed, like we saw happen in 2023. These projects cost billions and billions.
And the reliance on those government incentives you mentioned must be a risk itself. What if the money doesn't come through?
Exactly. They list that explicitly. The terms are often preliminary, non-binding. They have to meet complex requirements that actually receive the funds. Laws and government priorities can change. So there's a risk they might not realize the expected level of government support, which could impact the project's feasibility or timelines.
What about just the practicalities of building these giant, complex facilities?
Huge risks there, too. Construction delays due to permitting, environmental reviews, geographical challenges, shortages or cost increases for specialized labor, materials, and construction equipment, especially building leading-edge fabs at this scale in places like the U.S. where it hasn't been done as much recently. The risk of not finishing on schedule or going way over budget is very real.
And then, assuming they get them built, what are the risks?
Then the challenge shifts. Can they attract and retain the thousands of highly skilled engineers and technicians needed to actually run these advanced fabs? Can they ramp up production efficiently and cost-effectively? And maybe the biggest question, will there actually be enough customer demand for all that new memory capacity when it comes online later this decade? Building capacity years in advance is always a gamble on future demand.
That is an incredible stack of challenges tied just to the expansion. It makes sense they have a whole section on risks. What are some of the other major risks they highlight beyond the CapEx plans?
Technology and competition are right at the top. This industry is just brutally competitive.
Always someone trying to leapfrog you.
Constantly. Their future success depends entirely on developing and ramping new, competitive technologies faster or better than their rivals. The filing lists all sorts of technical hurdles. Getting good manufacturing yields and quality, especially for complex things like stacked HBM, hitting the physical limits of how much you can stack or shrink components, increasing the number of bits stored per memory cell, advanced packaging techniques, managing power consumption, ensuring reliability. It's nonstop R&D challenges.
And pouring billions into R&D, like for EUV, doesn't guarantee success.
No guarantee at all. They state that clearly. There's no certainty they'll get the return on those massive R&D investments. And meanwhile, their competitors, Samsung, SK Hynix, and others are doing the same thing. There's always the risk a competitor develops a breakthrough technology that makes Micron's offerings less attractive or even obsolete.
Supply chain must be another huge risk area for a global manufacturer like this.
Absolutely critical. They depend on a whole network of third-party suppliers for vital inputs controllers, for SSDs, other components, specialized chemicals and materials, foundry services for some logic chips, assembly and testing subcontractors, logistics providers, utilities like power and water, and crucially, the complex manufacturing equipment itself.
And issues with those suppliers can cause problems.
Big problems. For some highly specialized tools, like advanced lithography equipment, they might rely on just a single supplier. Any delays in getting that equipment can impact their technology transitions, their ability to reduce costs, and their production ramps. Many supplier contracts don't guarantee long-term capacity or pricing, so suppliers could allocate scarce capacity to competitors. Inflation drives up supplier costs. Sudden demand spikes can exceed what suppliers can provide. And there's always a risk a key supplier could face financial difficulties or insolvency.
And disruptions to their own global manufacturing footprint.
Yes, that's a major risk too. They have fabs and assembly test sites across the U.S., Singapore, Taiwan, Japan, Malaysia, China. They need reliable power and water at all these locations. Any operational mishap, equipment failure, natural disaster like an earthquake or typhoon, geopolitical instability, pandemic, an issue at just one key facility can disrupt their entire production network because manufacturing steps are often integrated across multiple sites.
Product quality seems like it would be paramount, given where these chips end up.
Extremely important. If their products fail to meet specifications or have defects, it can lead to huge costs, warranty claims, product recalls, potential legal liability, especially for chips used in critical applications like cars, like autonomous driving, or medical devices. It can also severely damage their reputation. They also note risks related to third-party components or firmware embedded in their products, which could have their own security vulnerabilities.
Cybersecurity is mentioned specifically too, right?
Yes, Item 1C covers cybersecurity risks. They talk about their security policies and procedures, aligning with frameworks like the NIST cybersecurity framework. They do risk assessments, and the board has oversight through a dedicated security committee.
Did they report any major incidents?
They state they haven't identified any cybersecurity incidents that have had a material impact on their operations or financials during the periods covered by the 10K. But they readily acknowledge that incidents do occur, and the threat landscape is constantly evolving. They also point out that the systems using their memory and storage products like cloud data centers, PCs, connected cars are themselves major targets for cyber attacks. A breach elsewhere could potentially impact Micron if their components are implicated, even indirectly.
Interesting. They also list AI itself as a potential risk, even though they make products for AI.
Yes, it's framed as a risk related to their use of AI and the nature of AI technology. While they use AI in their own operations, product development, and obviously sell into the AI market, they know that AI tech is complex, evolving incredibly rapidly, and its use exposes them to new competitive, legal, ethical, and regulatory risks. Implementing AI effectively can be costly, there's no guarantee of the expected benefits, and competitors might leverage AI more successfully. There are just inherent uncertainty about the outcomes and consequences of relying heavily on AI.
Talent seems like it would be a constant battle finding and keeping the right people.
Absolutely critical, especially in this industry. The 10K highlights the intense competition for skilled engineers, scientists, technicians, and other key employees. They need to offer competitive compensation, benefits, and a positive work culture to attract and retain people. High attrition rates, losing employees with critical skills, or difficulties hiring can disrupt their business and R&D efforts. Things like immigration policies or travel restrictions can also make it harder to hire or move talent globally.
And keeping talent is closely linked to protecting their intellectual property, I imagine.
Directly linked. Protecting their valuable IP patents, trade secrets, know-how is vital. Retaining employees who hold that knowledge is part of it. If key people leave and go to competitors, that knowledge can walk out the door. On the flip side, they also face the constant risk of being accused of infringing on someone else's IP. Patent lawsuits are extremely common in the semiconductor industry. Defending against those claims can be incredibly expensive, and if they lose, they might have to pay huge damages, license technology from competitors, or even be blocked from selling certain products or using key manufacturing processes.
Laws and regulations must be a minefield, especially international trade rules.
Huge area of risk and uncertainty. Their global sales and technology development are subject to a complex web of international trade laws, export controls, import tariffs, customs regulations, economic sanctions imposed by the U.S., the EU, China, and many other countries. And these rules can change frequently, sometimes with little warning.
How does that impact them directly?
Restrictions can limit their ability to sell certain products to specific customers or entire markets. Tariffs increase their costs or make their products less competitive. Regulations can restrict their R&D activities or how they operate globally.
They mentioned a specific example involving China, right?
Yes, they explicitly referenced the decision by China's Cyberspace Administration, CIFI, back in May 2023. That decision restricted operators of critical information infrastructure within China from purchasing Micron products.
And the impact.
They state in the 10K that this decision has adversely impacted their revenue from mainland China and Hong Kong. And they warn that further actions by the Chinese government could potentially impact their revenue or operations both inside and outside of China. The very direct example of geopolitical tensions translating into tangible business risk.
Definitely. Any other major regulatory areas?
They also mention risks related to broader geopolitical conflicts, compliance with regulations around conflict mineral sourcing, and increasing expectations around responsible supply chain management.
Tax is always complex for multinationals. What do they highlight there?
It's a big one. Calculating their income tax obligations across dozens of countries is incredibly complex. It depends on where they earn profits, how tax authorities interpret laws during audits, whether they meet all the conditions for tax incentives they receive, fluctuations in foreign exchange rates, and, of course, changes in tax laws themselves.
Anything specific on changing laws?
Yes, they specifically call out the OECD's Pillar 2 Global Minimum Tax Initiative. They note that many countries, particularly in the EU, have already enacted laws based on Pillar 2, mostly effective in 2025 for them. They don't expect a material impact in fiscal 2025, but they do anticipate it will significantly increase their overall income tax expense starting in fiscal 2026, particularly as key jurisdictions for them, like Singapore, adopt and implement the rules.
So potentially higher taxes coming down the road globally. What about purely financial risks?
They mention foreign currency exchange rate risk arising from their global operations, which they try to manage using hedging instruments like forward contracts. There's interest rate risk, primarily related to their variable rate debt, and credit risk, the risk that customers might not pay them or that financial institutions they deal with could fail.
And the debt itself, that $13 billion, is listed as a risk factor, too.
Yes, the obligations that come with carrying that much debt are spelled out as risks. Things like needing to use a large portion of their cash flow just for debt payments, which could reduce funds available for investment or weathering downturns, potential impacts on their credit rating and future borrowing costs, covenants or restrictions that might limit their operational flexibility, increased vulnerability to rising interest rates or economic slowdowns, and ultimately the risk of default if things went badly wrong.
And finally, they mentioned the volatility of their own stock price.
Right. They acknowledge that their stock price has historically been, and likely will continue to be, quite volatile, driven by a whole range of factors: their own financial performance and forecasts, the cyclical nature of the memory industry, changes in analyst ratings or outlooks, news about competitors, shifts in their capital structure, like issuing debt or buying back stock, broader market fluctuations, interest rate changes, regulatory developments. Lots of things can move the stock. This volatility carries risk for investors and also increases the company's exposure to potential securities class action lawsuits if the stock price drops sharply. Even things like share buybacks and dividends, while intended to benefit shareholders, can affect volatility and impact their cash position.
It really is a formidable list of challenges and uncertainties they face on multiple fronts. Okay, let's shift slightly and touch on how they describe their people and culture within the 10K.
Yeah, they have a required section on human capital disclosures. They put an emphasis on employee engagement, mentioning a program called Micron Voice. Sounds like their internal survey and feedback system covering topics like the work culture, leadership effectiveness, employee well-being, and inclusion.
What about the basics, like compensation and benefits?
They describe their approach. Typically includes base salary, potential bonuses, equity awards like stock options or grants, an employee stock purchase plan, and comprehensive benefits. They state they conduct regular global reviews to ensure pay equity.
Pay equity?
Yeah, fairness in pay, regardless of gender, race, etc. They report achieving global pay equity for all underrepresented employee groups in both base pay and stock awards during fiscal 2024. They also say they plan to continually assess their benefits packages, things like leave policies, medical coverage, financial wellness programs, to ensure they're competitive and inclusive.
Health, safety, and well-being seem important, too.
They mention proactive efforts to prevent workplace injuries and illnesses, with site-level health and safety committees and formal training programs. They also describe a well-being program built around 5 pillars: physical, mental, social, career, and financial health. This includes things like access to mental health counseling, fitness resources, on-site clinics in some locations, financial education, and support for caregivers, like help with childcare.
And they mention involvement with the Responsible Business Alliance, the RBA.
Yes, they highlight their membership.
Hmm?
The RBA is an industry coalition focused on promoting responsible working conditions, ethical practices, and environmental stewardship throughout the electronics supply chain. By mentioning this, Micron signals its commitment to adhering to the RBA Code of Conduct alongside its own internal code.
Okay, good to get a sense of their stated approach to human capital. Now, let's briefly cover executive leadership and some of the governance aspects mentioned.
Sure. The 10K lists their key executive officers, people like CEO Sanjay Mehrotra, CFO Mark Murphy, and the heads of major functions like operations, sales, technology, legal, and business strategy. It notes these officers are appointed annually by the board of directors, and the directors themselves are elected annually by the shareholders.
And details about the board structure, committees, and corporate governance policies.
They state that their detailed corporate governance guidelines, committee charters, like for the audit committee, compensation committee, and that security committee overseeing cyber risk, and codes of conduct are all available on their investor relations website. Standard practice to point investors there for the nitty-gritty details. They also describe how they communicate with the investment community using their website SEC filings, press releases, conference calls, webcasts emphasizing compliance with Regulation FD, which requires fair disclosure of material information.
Internal controls are always a key part of the 10K, item 9A. What's the summary there?
Right. Internal control over financial reporting. Management affirms its responsibility for establishing and maintaining adequate controls to ensure the financial statements are reliable. They evaluated the effectiveness of these controls as of the end of fiscal 2024 using a standard framework, the COSO 2013 framework.
And the conclusion.
Management concluded that their internal controls were effective. And, importantly, their independent registered public accounting firm, PwC in this case, audited these controls and also issued an opinion stating that the controls were effective. The filing also notes that any significant deficiencies or material weaknesses found would have to be disclosed to the auditors and the audit committee, and none were reported as material for this period.
Okay, clean bill of health on internal controls. They also go into detail about their insider trading policy, right?
Yes, item 9B discusses this, and the full policy is usually an exhibit. It's a crucial policy for any public company.
What's the core principle?
The main goal is to prevent employees, officers, and directors, basically anyone associated with the company, from trading Micron stock or stock of other companies they have info on based on material non-public information. That's significant private info that hasn't been released to the public yet and could affect the stock price.
So, preventing unfair advantages, what are some key rules?
There are strict prohibitions against trading during designated blackout periods, typically the weeks leading up to the public announcement of quarterly earnings results. These blackouts apply especially to people defined as insiders, which can be a broad group. Senior executives and directors, often called Section 16 reporting persons, face even tighter restrictions. They usually need to get pre-clearance for any proposed trade from the company's chief legal officer or CFO.
Pre-clearance, so they have to ask permission first.
Essentially, yes. They submit a request, usually get a response within a day or so, and if approved, the trade typically has to be completed within a few business days. But even with pre-clearance, they're still prohibited from trading if they become aware of material non-public information before the trade happens.
Okay. Any other key restrictions?
The policy also prohibits insiders from things like pledging Micron stock as collateral for a loan or holding it in a margin account due to the risk of forced sales. There are also specific rules around how stock options can be exercised and how shares acquired through equity compensation plans are treated.
What about those pre-planned trading schedules people hear about? 10b5-1 plans.
Right, Rule 10b5-1 trading plans. The policy allows insiders to set up these plans. The key is the plan must be established before the person possesses any material non-public information. It specifies future trades, dates, prices, amounts. Once the plan is properly established and approved by the company, trades under the plan can occur automatically, even during blackout periods or if the insider later learns non-public info because the decision to trade was made earlier. But setting up or modifying these plans is tightly controlled and requires pre-approval.
Sounds like a comprehensive set of rules to prevent insider trading issues. Okay, one last crucial area from the 10K, critical accounting estimates. These are the judgments management has to make that can significantly swing the financial results, right?
Exactly. These are areas where the numbers rely heavily on assumptions and estimates about the future, and if those assumptions turn out wrong, the actual results could be materially different. The filing highlights several. Contingencies. This relates to estimating potential losses from things like lawsuits or regulatory actions. Management has to estimate the probability of a loss occurring and the likely amount, which involves a lot of judgment.
Okay, what else?
Impairment testing, especially for goodwill. Goodwill is an intangible asset on the balance sheet, often resulting from acquisitions. Companies have to periodically test if its value is still justified. This involves making significant estimates about the future performance of that part of the business, forecasting revenue growth, costs, cash flows, and choosing an appropriate discount rate.
Did they report any impairment?
Yes, as we touched on briefly earlier, they recorded a $101 million impairment charge against the goodwill allocated to their storage business unit, SBU, back in fiscal 2023. They attributed this to the challenging macroeconomic environment and lower demand forecasts impacting the estimated future cash flows for that unit at the time. They noted that for their other units, the estimated fair value was still substantially above the carrying value.
Income taxes are listed as critical too.
Yes. Given their global footprint and the complexity we discussed. Estimating their tax provision and liabilities requires interpreting complex tax laws in many countries. A key judgment is evaluating whether they'll likely realize their deferred tax assets, basically, prepaid taxes or credits. This requires forecasting future taxable income in various jurisdictions, which is inherently difficult, involving projections of prices, volumes, costs, spending levels, etc. Compliance with conditions attached to tax incentives also requires judgment. And again, they reiterate the expected significant impact of Pillar 2 rules starting in 2026.
And finally, going back to that core volatility, inventories are highlighted again as a critical estimate.
Absolutely. This is the lower of cost or net realizable value NRV calculation we talked about. Determining the NRV requires management to project future average selling prices, expected sales volumes, and the estimated cost per part for all the inventory they hold.
In the memory market, those prices are notoriously hard to predict.
Extremely hard. The market is highly volatile. So these estimates are inherently subjective and can change rapidly. A small change in the price forecast can have a huge impact on whether they need to record a write-down.
And that's where that $700 million potential impact from just a 5% price estimate change comes in.
Yeah, exactly. That figure, disclosed in the 10K, perfectly illustrates why inventory valuation is considered a critical accounting estimate for Micron. It shows just how sensitive the reported financial position is to these judgments about future market conditions.
Wow. Yes, seeing that number really connects the market reality to the accounting. It brings home the sheer volatility they operate under.
It absolutely does. These critical estimates are really the interface between the external market chaos and the structured world of internal financial reporting.
Well, this has been an incredibly thorough journey through Micron's 2024 10K. We've really covered a lot of ground, starting with the basics of who they are and what they do.
Right. Looking at their cutting-edge products, DRAM, NAND, HBM, that power so much of our modern world, from massive data centers right down to your smartphone.
And we definitely spent time navigating those significant financial swings they've experienced, particularly that massive dip in 2023 and the partial recovery in 2024, really highlighting how tightly their results are tied to memory chip pricing and manufacturing efficiencies.
Then we explored their really ambitious multi-billion-dollar plans for global expansion, especially the huge new fab projects in the U.S. and the critical role that government incentives are playing in making those possible.
While also digging into the extensive list of risks they face, the constant technology race, complex supply chains, geopolitical tensions like the China restrictions, cybersecurity threats, the challenges of attracting talent, intellectual property battles. The list goes on.
Yeah, and we touched on how they manage their finances to things like debt, share buybacks, dividends, their stated approach to people and culture, the governance structures, internal controls, and even the detailed rules executives have to follow when trading company stock.
It paints a picture of a company operating right at the forefront of critical technology, needing to master incredibly complex manufacturing, navigate volatile global markets, and shifting government policies, all while managing enormous investments and a daunting array of risks just to stay competitive.
It really does. The scale of everything involved is just immense.
And it leaves you with a thought, doesn't it? You look at these massive investments Micron is making in new manufacturing capacity around the world, so clearly enabled by and dependent on government funding and incentives as laid out right here in their own filing.
Yeah.
And you set that against the backdrop of the extreme market volatility we saw, the relentless pace of technological change they have to keep up with, and the very real geopolitical risks they explicitly call out.
Yeah, it makes you wonder, what does all this tell you about the sheer complexity and maybe the necessary interdependence between corporate strategy and national industrial policy that's required today just to compete, let alone lead, in the strategically vital semiconductor industry? How much does the future of high-tech manufacturing now rely on both companies like Micron and governments effectively working together, navigating all these challenges in tandem?
A really fascinating question to ponder. Thanks for joining us on this deep dive.